Let's bring in another couple of voices to talk about what's happening in the markets. Heinel is with State Street Global Advisors. Jon Hill is with BMO Capital Markets. And Lori, let's start with you, just what you're watching in the equity markets, maybe what you're hearing from other people in the markets, potentially clients that you talk to, about how they feel right now.
Well, everybody feels a little bit sick. I mean, obviously, these massive gyrations in the market aren't giving anybody any comfort. But I think what everybody's looking for is some signal that we can manage through the short term. So some of the policy responses have been very much welcomed because it helps to, allay some of the worst fears about the short term. But really, when are we going to start to see some progress against the virus itself? And that would give us sort of more confidence that we're getting some sort of a recovery in the back end of 2020.
And John, what about you? The fixed income has been the place that's been most affected so far by the strategies we've heard from both the Fed and the Treasury. What do you think of the actions they've taken to this point?
I mean, they're doing whatever they can to soften the economic blow of something that is undoubtedly coming. The reality is the Fed cutting interest rates helps on the margin, but doesn't address the underlying fundamental issue. Just because financing costs drop 100 basis points, 150 basis points, whatever, doesn't mean that you can go out and spend money and support the economy as a consumer if everything's shut down. So it really is just a game about trying to buy time, and I think both sides are trying to do that. The fact that bonds have really rallied, not fully to the effective lower bound, but starting to push that level, it really indicates that the Fed has fired the majority of their mainstream bullets. It cut rates to the zero lower bound. We're going to be here for an extended period, and they've launched a massive new quantitative easing program, all in the hope just to try to stabilize things and kind of keep the train on the tracks, if you will.
The last 3 or 4 trading days, we've been talking about the pressures and the stresses in the Treasury market. You think it's been mostly resolved at this point?
I mean, it's still way too early to say. The actions really are just an attempt to try to keep things going. Liquidity is still highly deterred. One place in the market that I'm watching closely is the TIPS market. So inflation-adjusted returns are very positive. If anything, we should be seeing closer to zero, if not substantially negative. So there are dislocations from fundamentals. Everything we hear is that liquidity is difficult. And we're also seeing a lot of pressures in funding markets. Despite the Fed's best effort to inject huge hundreds of billions of dollars of a backstop in the repo market, commercial paper, and a variety of other funding situations, liquidity is still poor, trading is still very, very choppy, and it really is just kind of about trying to keep this incredibly important market liquid, or at least a little bit liquid, and functioning while people are trying to hedge risk and get invested.
Lori, in the meantime, the fiscal policy is still being debated in Washington, still being put together, and there are more critics who are already kind of weighing in on any potential bailouts that might happen. That leaves things pretty uncertain for equity investors at this point. There may be bailouts. It may not mean that equity investors are made whole or even given anything.
Well, look, I think there are a couple of dimensions to this. First and foremost, the main thing that's happening now is you've got the consumer sector being really impacted here. In the U.S., one of the things that we had written about earlier this year was this kind of divergent economy where we had manufacturing that had been under pressure through much of 2019, but yet the consumer services area had held up pretty well. So this is really striking at the heart of that. So some of the policy imperatives that take a little bit of the sting out of the consumer pocketbook, give them a little bit of capital, a little bit of cash, the ability to weather through the storm, through the layoff periods, things of that nature, are actually quite positive. But here again, it always going to be a function of how long the duration of this shutdown, slowdown, stay at home is going to be. Because if it's really just one quarter, and right now our forecasts are that the second half of 2020 we see a rebound, then that could actually, we could weather that pretty well. But if it's something where the disease continues to accelerate, there continues to be fear, we continue to have elongated slowdowns, then that becomes a lot more difficult to model.